Please welcome your panelists for Real Estate Outlook, a more attractive asset, moderated by Bloomberg TV's editor-at-large, Erik Schatzker.
Good afternoon, everybody, and welcome to the Real Estate Outlook. As God just said, I'm Erik Schatzker. I am delighted to welcome a very distinguished group of panelists. I'll introduce you to them briefly. If you'd like to read up a little more, of course, the Milken Institute has kindly provided us with very detailed biographies. Let me start on the far right. We have Neil Bluhm of Walton Street Capital. Immediately to my right is Bob Morse of the Bridge Investment Group. To my left, Eyal Ofer of Ofer Global. To his left, David Simon of the Simon Property Group. And finally, Sam Zell of Equity Group Investments. I mentioned that they're a distinguished group of real estate investors. What makes them different, however, is that they don't all do the same thing. And I think that's going to become clear. Some of these gentlemen are highly specialized in what they do. David, for example, of course, is focused on largely malls in the retail industry. Bob is focused largely on value-added investments in real estate. Some of our other panelists range more widely. Together, I think they're going to provide you with a really comprehensive sense of the outlook for real estate as an investable asset. And I think I'm going to begin with a very simple question, which is, where are we in the real estate investing cycle? Which of you guys would like to begin with that one?
The 11th inning.
The 11th inning of a how many innings long extra inning game?
Longer than I expected.
What does that mean, Sam, if we're in the 11th inning?
I think that, the bottom of the recession was 2009. We had a very unusual set of circumstances where from 2009 until 2015, we built almost nothing. I don't think there's ever been a period since World War II where we've ever built that little. Now, we're getting to get reacquainted with oversupply. And over the next 24 months, I think we're going to see a lot of new buildings.
I don't know what 11 innings mean.
What did he say?
I don't know what 11 innings mean because I'm not familiar with American football. But
it's baseball, yeah. Baseball.
Just shows you how much I know about it.
I think what Sam is trying to say is the carton of milk in the refrigerator is well past its best before date.
Bravo, and I agree with that.
Why?
And the world is awash with money at quantities which are unprecedented. And this money is chasing assets at a level which has not been seen before. And it causes asset values to increase and yield to compress to a level which any change in interest rates or inflation will make them unsustainable.
Any change?
In inflation and in interest rates.
You know, Erik, I think that in answering that question, in part you have to put it in relative terms compared to other markets. And we've heard a lot about the equity markets and how equity valuations are high, how interest rates are going to rise, et cetera. And in real estate, I think that there's potentially some value left on a relative basis compared to what are some pretty lofty valuations in the equity markets. Now, it depends on what you buy, where you buy it, whether you're investing in the U.S. or overseas. And in some respects, the core markets, which are pretty closely correlated, at least historically have been very closely correlated to interest rates, seem quite pricey. But in some other parts of the asset class, there may still be some opportunity to eke out some alpha at the asset level.
Do you feel in principle, would you agree in principle with these other two gentlemen that we're pretty far along?
Everybody who I've spoken to at Milken says that we're very far along, so it must be right.
Consensus is a dangerous thing.
But everybody is very cautious, and nobody has been able to articulate why we're so far along and what the excesses are that should precipitate a downturn.
So why don't we ask David Simon or Neil Bluhm to give that a try? Why are we so far along if the excess is, apart from the, and I'm not sure I'd call it an excess, but the surplus of capital is the only one that we can see?
Well, we're in a, I agree that we're late in this cycle, but we're in a very different environment now. We're in a situation where property prices are very high because cap rates are low, because interest rates are very low. We have interest rates now moving up. People have thought they were moving up over the last several years, and they finally are starting to. And you have a situation where there's a disconnect between buyers and sellers. The buyers are expecting prices to be going down, and the sellers are still looking in the rearview mirror. I think cap rates have probably moved up, except for really prime assets, maybe 50 basis points. On the other hand, and there is some development, much more now than there was, as Sam said.
Some, Neil?
Well, Sam, you're looking at a lot of apartments. There's more apartment developments.
How about office space?
It is starting in...
How about hotels? How about industrial?
There is development all over, except in retail.
Oh, good, okay. I'm going to write that down so I don't forget.
All right. But I would say this, if we're going to have higher interest rates and we're going to have inflation, where it's going to be more expensive to develop new properties, especially with steel, et cetera, you will, looking out 3-4 years, you're going to see a slowdown in construction because you won't be able to get a reasonable return on your cost of capital, on your cost of building the property as you look into the future. But that, right now, you still have all the projects coming on that have been planned and under construction.
I don't know, from my experience, Neil, higher interest rates and a higher level of inflation does generate, or tend to generate, higher level of rent. This is textbook. The only thing which may hold it back is oversupply.
So where do you come down on the oversupply?
I think that we are in a stage of oversupply.
I'll write that down, too.
We're in the 11th inning.
Are we still in the 11th?
11th inning.
We're still in the 11th.
I would just say, I would say it feels like late cycle. But I think you have to bifurcate it with the private and public markets. Because if you look at, and I'd also say that real estate, even if it is late cycle, despite some oversupply in some product in some markets, you're not don't expect the carnage to happen, you know, the way we've seen real estate bust. And I think that's the difference here. Even though we're late cycle, I don't expect a dramatic valuation change for real estate.
Why is that? Real estate is,
Because
time
I
and
think,
again seems to be
well, I
an
think
industry
a lot
so
of
prone to boom and bust.
Yeah, well, I think a lot of it is the discipline that public companies have brought to bear in the real estate world. I also think that the underwriting from the financial institutions has gotten a lot more stricter. So let's take an example, and believe it or not, we've all lived through the real estate recession in the starting in 88, 89, lasting to 93, 94. That was a real estate recession. The one that occurred in 08, 09 was child's play. And I think it was short and it was temporary. In fact, real estate really, a couple of people made some huge mistakes, but overall the industry bounced back pretty significantly. And I do think even with late cycle, I'd expect some adjustment, but not dramatic downfall like we saw in the early 90s. And in fact, if you look at the public values today, they're basically already, and whether they're right or not, you know, I'd argue that they're not necessarily right because I think the business is better than what the public markets think, but they're already adjusting for, you know, the late cycle. If you look at the private values versus public asset value, you know, there's 25 to 30% difference. So they're already, assuming they're looking to, in the future, they've already priced in kind of late cycle values.
That dichotomy is really interesting because the public REITs have gone down pretty significantly in price. They've way underperformed this year. And yet, at least when we go out either to sell assets, there are enormously competitive and attractive bids for the assets that we're selling in the private markets. And when we try to buy assets, the terms and conditions under which to which you have to submit in order to put an asset under contract have tightened up pretty significantly. The amount of time that you have to do due diligence, the hard money that you have to put down, both have gotten much more favorable to the seller. We benefit from that sometimes. We struggle with that sometimes. But there is that public-private dichotomy that asks the question, you know, which party is right?
Bob, maybe you can give me some advice, because I've obviously been in the wrong arena than you have. We've sold about $10 billion worth of real estate in the last 4.5 years. 4.5 years ago, we put something up for sale, and we had 30 buyers and 20 of them ready to go hard. 2 years ago, we put something up for sale, and we had 10 buyers and 2 ready to go hard. Now we put something up for sale, and we wait and hope that somebody will show up. Now, maybe we're only operating in 48 states or something, so we may not know what you're talking about. But but I can tell you that, the biggest element that's going on in the real estate market today is like the unicorns in high tech. You create the unicorns so you avoid price discovery. You stay in the private market to avoid price discovery. The public market is price discovery. And the public market is telling you a very different story than the private market. But the private market, when the guys get slaughtered, they don't make the headlines. In the public market, they do. So I think you're, kidding yourself.
Well, I'm sure I can't give you much advice. Although
I'm willing to listen.
If you have assets that no one is bidding on, we'd love to look at them.
That's the reason nobody is looking. There is too much.
Maybe it's the different sectors within real estate. Some are, of course, more attractive than others. And I'm just talking about the U.S. And I know many people on the panel have a much more global footprint and presence than Bridge does. But the U.S. is a pretty attractive place in which to invest. There's a lot of foreign capital. I was in Korea about 10 days ago, and Korean investors still are looking for single-digit yields on real estate investments that they make, and at least in the markets in which we participate, single-digit yields are at the very low end of what the targets are. They're not the core markets; they're the value-add markets. So there's still we found that there's still a pretty strong bid for selected assets.
Well, I find that there's a low-digit Korean time frame, that says if we start today, maybe by the turn of the 22nd century, they'll be ready to close. If you go that slowly, you can get a big price.
Look, I don't think there's any question that there's not nearly as many buyers and sellers transacting right now. The number
Brilliant.
of
You're right.
transactions are down enormously. For the reason I said earlier, you've got a disconnect. But you also have a disconnect between the prices of the public REITs and the private market. The question is, which one is right? My guess is it's somewhere in the middle, okay? That is that prices of the private are going to go up, and at some point, the REITs will readjust. The problem with the REITs are
That's the reverse. Private will go down.
Private prices will go down, no question. In the because interest rates are going up, and we're not going to have this low of a cap rate in perpetuity. And that's what's going on. On the other hand,
but Neil, the only thing I'd say is that real estate is, it's got better value today versus other equity securities today. So to me, that's, even though there may be this adjustment because rates are going to go up or there's more supply and values are going to come down, it's still better relative value today, real estate, than it has been vis-a-vis other equity instruments. I mean, now that we're talking our book, but I mean that is a unique, the way REITs are priced today versus how they are measured vis-a-vis the S&P is one of the lowest it's been. It was as low, you know, I remember this back in kind of 1998, 2000 level. So that's what makes real estate, even though there may be this adjustment in values, it's still relatively attractive today than it was 2, 3, 4 years ago.
One of the points that you addressed directly, David, was what the bust when it comes is going to look like, and we have indirectly addressed the precipitating factor, interest rates and inflation. Before we get to the end, what beyond interest rates and inflation might bring this cycle to an end?
Eric, it's called supply.
Yes, of course.
Which
I forgot
has
about
brought
supply.
the end to every single real estate scenario. We've been handled, we survived through 21.5% prime. The real estate industry didn't go broke. Prime was 21.5. So when it's all said and done, what created the depression that David was talking about in 89 to 93? It was the Japanese. You know, they came in with bushels of money. They said in Tokyo this building would be a 2% return. I can buy it for 4. And then it got empty, and then he sold it for 50 cents on the dollar.
Because he financed it in yen.
Because he financed it anyway, okay? There's nothing different than today, than the past. It's all about supply. And there is a tsunami of supply coming down the road. And if somebody in this panel can explain to me where the demand is going to meet that tsunami of supply, then we got something to talk about. Am I
Anybody?
being too subtle?
There's a book. There's a book.
Yeah, that's right.
He's plugging his book. Go buy his book, would you please?
Sam,
It's better
Sam,
than
we
Steve
talked about
Klubeck's
this
book.
He's talking
okay?
there is a huge supply of apartment buildings in the downtown areas where all the young people have moved because there was a tremendous demand for apartments, and that's going to continue. So you're feeling it more in that area. But the amount of development in office, certainly almost nothing in retail, okay, is nowhere near that much of a huge hit.
Neil,
but it goes market by market.
Neil, I think that I'm the largest owner of CBD apartments in the world, okay? And I can tell you that, yes, there's supply, and our occupancy has gone from 98 to 97. Our rents have gone from up 4 to up 2, okay? That's with the supply we're talking about.
What about concessions?
What about the who?
Concessions. How many months
Even
free rent are you giving?
Not anywhere near what it's been in the past, okay? On the other hand, I'd say the existing supply of retail represents the tsunami. You don't need to build anything, and it's going to be too much. Office space. Somebody's building something called Hudson Yards. 14 million feet of new space in New York. Next door to it is Brookfield, 5 million square feet of new space. Next to it is Penn Central Station. Vornado owns 7 million FAR, unbuilt yet. 9 million of all that space has been filled. Committed, not filled yet. what happens to all of the holes that create? We're going to get WeWork take it over? With your credit, it's a deal.
Sam, that's New York. I have office buildings
Okay, how about
in LA.
Chicago?
The market is
How about
strong.
Chicago?
Rents are going up. There's
How about
not a lot of new
Chicago?
There's
development.
one business that's better than retail, or than offices retail. I just wanted to go on record. Office building, the effective rents go down every single year without question.
Absolutely.
Okay, so
Absolutely. I mean, you know, TIs have almost doubled in the last 3 years in new office buildings across the country. You don't think that's a concession?
So, Sam, do you feel good about your multifamily exposure?
Yes, yes. You know, within reason. In other words, I think I'm a realist.
Because
okay?
we don't see a lot of new supply in multifamily. Certainly no new Class B supply.
I'll send you some pictures.
Send us some assets.
I'll send you some pictures, okay? You know, I mean, somebody is going to pretty soon figure out how much industrial space is under construction, and how much of that space is all committed.
there's no alternative use for that stuff either.
Right,
Okay,
no. But, you know, the answer is that everybody thinks that their building is going to be leased to Amazon. Everybody, okay? So, you know, and God forbid you don't get the Amazon lease. You know, it's like Ghostbusters. Who do you call?
I told you that if Sam is in a good mood, we are going to have a good discussion here.
Eric, you were worried about this being lively.
Yeah.
You want to change seats with Sam?
Yeah.
Let's get to the bust. You know,
You want to
in
say
other
something?
industries, right, there is occasionally something called supply destruction. It happens in mining, for example. In real estate, unless you're in Detroit, there isn't really supply destruction, is there? So if you think, I'm not sure whether this is a question for you, Sam, or you, Eyal. We heard a bit of David's point of view on the subject, or you two gentlemen here, but David thinks that when the bust comes, it's going to look mild, say, relative to what happened in 88 to 93.
Is that like leprosy is better than cancer?
I don't think anybody has a response to that. Sam.
Do we agree? Do we agree with David that it's a mild, call it recession in real estate, or is it uglier than that?
Let's start with the original premise. There's more money out there than there has ever been in history.
Bravo.
Do you think that all that money is not going to create loans to build new real estate? Confucius says, developers will build when money is available.
It was Herzl.
You know,
Oh, Herzl, maybe you're right.
the difference that, just to defend my spot, even though Sam, you know, likes to make fun of my spot.
No, he did not. He meant it.
Of course, but
I'm not. You're in the retail business. I can't make fun of you. I can be sorry for you.
by the way, I just want to go on record. We actually had more operating income than Amazon in the quarter to quarter, but who cares about that, right? But just to go on record, you know, whenever I walk around in any room, people go like, "How are you, David? Are you doing okay?"
Yeah.
Okay. Everybody feels sorry, which is, by the first time anybody ever felt sorry for me, so it's great. We're doing just fine. And in fact, I don't mind a little carnage because that's when we've done our best work. So we tried to buy our competitor out of bankruptcy in 2009. It was the only real disaster. Which was General Growth. But we, you know, had to deal with Bill Ackman. It was a little complicated. But point is, there is so much capital. They are waiting for if there is a down cycle, that in the other than Sam, who's the original opportunistic money, there wasn't that money in 88 to 93. Very little bit. And then Neil and Sam really started the kind of opportunistic money. So when there are these busted deals, whether it's because of the credit cycle or because of too much development, there's capital to pick it up on the cheap. And that I think smooths things out a lot more than what we saw in '88 to 93 or 4. I mean, that's the difference. And there will be a cycle here, without question. We haven't had it in a long time, and I don't think we had it in '08 and '09. I really don't. But I don't know, Neil, and so, I mean, to me, it was so short and so temporary, it really wasn't what I'd call a traditional real estate cycle.
We went into the '07 recession, the first time since World War II, where the country went into recession and real estate was not in oversupply. First and only time. Every other recession started with real estate oversupply. The recession hit, the oversupply got worse because demand disappeared. You're going to have a similar scenario here. You know, I raised the first opportunity fund in real estate in 1989. I remember pitching the insurance companies and the pension funds, who, by the way, had plenty of money at the time. The problem was they sat down with me and they said, "What do you mean we're going into oversupply? My MAI appraisal says I'm in great shape. Why would I want to finance buying distressed properties? There's not going to be any." That's what the source of money said. Now you think in 2020 these savants are going to get smart? Unlikely. Just unlikely.
What do you say, Neil?
Well, first place, Sam, you were talking about developers. In all fairness, I don't think you've ever built a building, have you?
I have, goddammit, and that's why I haven't built another.
Well, you probably built one and it didn't work out.
Three.
You've been
No.
smart.
Three.
Three, sorry.
Three. I was 3 for 3.
It's been harder to get construction financing over the last several years, in part because of the rules, the bank rules, in terms of how much equity you needed, how much the banks will loan, and it's been very hard to really get a lot of overdevelopment. I'm not saying that we don't have it in some areas, but I'm much more in tune with the argument that's been made that we are in the late innings. We're going to have a slowdown. We're going to have a correction, but it's not going to be a giant problem like 1990 that we both lived in, where there was massive overbuilding and a recession, and everybody thought that you would survive anything, that it was great to just own good real estate.
Neil, except one exception. It's true that the bank regulator said no wild lending into new builds, into construction anymore. And in came all kind of clever funds with very clever money and said, I'll bridge the difference between what the bank gives you and up to 90% or even more at a higher cost. And this really propelled a lot of people to get into developments which were otherwise not been dealt with. And these opportunistic funds have made a lot of money picking up this gap between the regulator,
credit funds.
Yeah, the TCIs of the world and others, who came in and said, I'll give you up to 90%, or I will bridge anything between what the bank gives you and what we think the future value is, and I'll give it to you at 10 to 12%.
We don't do a lot of development, so I don't really know much about what the cost of development loans is, but I must say in financing assets, spreads have come way down from what they were just a couple of years ago, even as interest rates have gone up, as LIBOR's gone up. And where we were borrowing at LIBOR plus 250 a few years ago, we're borrowing at LIBOR plus 160 to 175 now for multifamily assets. And it's kind of surprising how aggressive many banks are. Often there are multiple bids in that respect. If the velocity of money decreases, if some of that $11 trillion that's been injected into the financial system starts coming out, if the Fed tapers more than it's been doing, I could certainly see spreads going up, and when spreads go up, that's going to have a negative effect on prices for sure, because what you can return on a leverage basis, not being crazy about leverage, not using mezzanine, not using preferred equity, is still quite strong relative to other asset classes.
Eyal, you're as global an investor as anybody on this panel. If you were to look around the world, what's the most overpriced real estate asset class?
Oh, easy.
Sam is dying to answer this question.
No, he was just describing it to us 2 seconds ago.
Yes.
It's offices and residential.
Where?
U.S. mainly. I'm talking U.S. If you go
Class A coastal office space?
Class A. I know very little between the two coastal areas.
And residential at the high end or the low end?
At the high end.
Sam?
Well, I mean, Hong Kong is that's what Eyal and I were talking about a few minutes ago. Pricing in Hong Kong is beyond the pale.
But it's not reflective of any market condition. It's
Right.
mainly, it's flight capital.
Because
It's a
why?
tool.
Because there's no supply.
Right.
Well, guess what?
There is no place to supply additional. The Hong Kong has been built now, building on building on building. I mean, there is hardly any oxygen left between the buildings.
Yeah, but that's right. But basically, adding supply is very relevant. I wanted to comment, Neil, on what you said about the cost of construction. There's no doubt that the cost of construction is going up. But I think what people don't look at is that the accordion in real estate values is not the cost of construction.
It's cost
It's
of land.
the value of the land.
Yeah.
When I went to Hong Kong for the first time in 1980, I was stunned when the guy explained to me that the land value was 80% of the value of the asset. In 2000, an FAR in New York, a floor area ratio, sold for $50 an FAR. When I sold Equity Office in 2007, the most recent FAR number was $1,500.
Yep.
So the accordion went from $50 an FAR to $1,500 an FAR in 7 years. If it went that much in 7 years up, who's to say it can't go down? I think it was Will Rogers who said, in 1928, buy land, they ain't making any more of it. He obviously never drove through Florida or California or Nebraska.
So, U.S. high-end office space, luxury residential. You agree?
Yep.
And Hong Kong.
Sure.
But Hong Kong is not.
But there's no reckoning coming
Yeah.
in
Hong Kong is not real estate.
Yeah.
Yeah.
Hong Kong
sure.
is a safe haven.
Yeah. As New York fancy, expensive apartments was the same thing for a
Was.
while.
Bob, in the markets in which you invest, what is the single most overpriced asset?
I agree with the two comments that were made. We were talking about Hong Kong earlier, and Hong Kong has a real deficit in terms of land. So there's 1.3 billion people in China, all of whom want an
Helps to
apartment in
explain
Hong Kong. We've done a lot of work comparing the gateway cities to some rapidly growing secondary cities, and the comparison is pretty stark. There's a lot of new development in the gateway cities, both in residential as well as office, and there's not anywhere near as much when you get to places like Atlanta or Dallas or Denver to a degree, Seattle and other places. And so I think the equation is much more in balance when you get away from the coasts and when you get away from the gateway cities.
And I would just say, Eric, that in my sector of the world, it's and there's no price transparency now because there's no trades, but a couple of years ago was street retail in New York City, in London, Paris. those kind of markets. Paris is held up. London is, on the verge of cracking. New York has cracked with no transparency. And I could never get comfortable. We looked at every deal there ever was in street retail. It's never been our business really, but I could never get comfortable in the pricing. End up being, a lucky call. But that market now it's no longer that market's busted. Okay,
It's in the process of correction.
it's busting as we speak. But
How much do you think General Growth lost as a result of that strategy?
They lost a few bucks. I mean, I can't.
$2 billion?
Probably not quite, but probably in the billion range.
By how much do, let's call it high street rents,
Yeah.
in New York City have to come down before that market begins?
They
to
probably
clear
have
again?
to go, and I'm not an expert because I'd say they have to go in half, essentially. Because they had such a...
At least.
Such a...
But David, the cost of construction is going up.
Well, that's supply and demand, so let's go back.
Really?
They had such a artificial increase in market rents. And in our business, we kind of see the 3-4% a year, so we've never had that, but there was such an artificial estimation of what market rents were going to and what they are. But I would say at least half, but you think more.
But the supply side
Yeah.
on the street retail, on the high street retail, have not increased.
Yeah.
It's only the demand side
Yeah.
have decreased dramatically.
Yeah, but
Because of the disruption.
they valued the buildings on market rents that are unattainable,
Totally.
completely
They were
unattainable.
talking about they were able to rent at $2,500 a square foot,
Forget it.
and then sell the street retail side
Sure.
of it, carve it out of the building, and make the whole building worth a fortune.
It's like selling the penthouse for $10,000 a square foot
Yep.
and saying the rest of the units are worth $9.
This is why the English retail rent system is so sophisticated, because the first 10 feet of the exposure to the street, you get 200 pounds a square foot, and then it decreases dramatically as you go inwards.
Sure.
But in New York, at the peak, they were saying 2,500 square foot, including the basement
Yeah.
And the second floor.
and the second floor.
And it was based on square footage that was even more than what the actual square footage was.
Yeah,
of
because the
course.
street is
Of
included.
course.
Well, doesn't retail go to the center of the street?
Exactly.
How far or how fully played out is the e-commerce effect on retail at the moment?
It's had no impact on it at all.
What do you say?
Let the record
No
show.
impact.
Let the record show, no impact.
No impact. Somebody's taking notes
Look,
here.
there is. It's very interesting. I mean, I could talk long, and I won't bore people, but retail. A bad mall is hard to kill. Okay, and it takes years and years for it to basically put out of business. We had too much mall product in our industry. The shelf life of a bad piece of real estate in a bad mall used to be 10 years. Now it's 2-3 years. And the one common denominator of a bad mall is basically the fact is it was built, two things happened. It was built 30, 40, 50, 60 years ago, believe it or not, and the neighborhood demographics changed. Or, and this goes into the late 80s, the developers were building malls on the basis that the growth was going to go up this corridor, and it went left or went right or it stopped. But the reality is you can't replicate good real estate, and I think we're just cleansing the system. We're rejuvenating retailers. We've had all sorts of things happen with our retailers, private equity. All these guys are my friends, so I don't like to insult them, but private equity put too much leverage on retailers. Retailers misspent on, say, buying stock back at levels or investing too much in technology. It's starting to turn, and we're starting to see more stability in demand, and retailers work their balance sheets and starting to see a level of stabilization.
Is that to suggest it's are you? It
I'm
starting to
suggesting
stabilize makes
that-
it sound like it's kind of played out.
Listen, I'm suggesting that our company is, it's like anything else. You got to look at company by company, mall by mall. Listen, we have outlets in Japan, and if you made a decision that Japan had no, the macro environment in Japan was terrible. Now it's gotten better, but over the last 20 years, you could have made the decision, I'm not going to invest in Japan because, you know, there's no growth, the aging population. Well, the reality is, you know, it worked in our favor because, you know, people stayed at home and they shopped and they love our outlet centers. So again, real estate is so specific decision. There's these macro things, but at the end of the day, you could have a very successful company or a very successful mall if, in fact, you know, you have the best real estate in the area. And so I do think there is a tilt a little bit less toward e-commerce, more toward the physical world. But it's a force, and it will increase the obsolescence of bad retail real estate quicker. The excess supply will get flushed down the system, and the good stuff will get better. And, you know, I would just, you know, if you want the evidence of that, it's very simple. We're a public company. We report every quarter. You can see a company that can navigate its way through this, you know, period of time. And, you know, so it's not, don't feel sorry for me, okay? It's okay.
We don't.
Okay, I didn't think so. But it's working its way through the system, but there is a reason people still want to go out and you know, be in an area that will, you know, that they can shop, play, work, etc. I mean, that's the nature of our society.
So David has a front row seat.
Yeah.
Does anybody else want to take a stab at how fully played out the e-commerce effect on retail is?
Well, the only comment I'd have is you already have had on the street retail, like in New York, I think the rents are down already, maybe 30, 40, at least percent, probably more to go, because rents went up so high that it was crazy. And you had all these retailers that felt we had to be in New York. We'd pay anything to have a flagship operation there. So rents have come way down. At some point, there'll be some opportunities. But we are not in an environment today where, number one, there's not a lot of distress right now in the real estate. The closest thing would be some retail, maybe, where the prices have come so far down. But the other side of it is, and prices are high, but do you know of other assets that are cheap? I mean,
I don't know. Do you? Is anything cheap?
I can't think of many. Do you think maybe oil is cheap or natural gas? But everyone's afraid we're going to produce so much oil and we're going to not have as much demand over the long term. But generally speaking, you name it. Bonds aren't cheap. They're probably the face value is going to go down as interest rates go up. Stock market is trading at high. It's a little off. The art world, my God, it's insane. Sport teams.
High-end residential, right?
High-end residential, my God, what do you pay? Guys have paid $9,000, $10,000 a foot for a condo in New York. So we are in a world because of low interest rates and the fact that we've had asset values go up because rates are low. Everything's expensive, and real estate is no different.
You know, just because we have a full room of audience, and presumably there's some interest in real estate, and we've been so negative over the course of our time up here. I think you can also look at some of the niches within real estate that could be interesting, and you know, maybe they're big enough to justify an investment strategy, and maybe they're not, but perhaps in the aggregate they might be. Seniors housing has good fundamentals around it. David mentioned live, work, play, and there are a number of new developments that sort of combine living and managed living with commercial or office on the ground floor. We reviewed an asset recently that had a first floor of different businesses, and then the ensuing 7 floors were organized by profession. So you had graphic designers on one floor and software engineers on another floor, and there was a lot of collaboration. These for young men and women who were out of college and looking to start their way in the world. Something like 42% of the U.S. population is going to be either freelance or independently employed over the course, is projected to be over the course of the next 5 or 10 years or so. So I think that their manufactured housing is an interesting area. As well, there's a bunch of modular technologies that may help to reduce the cost of construction that might offer some opportunities as well. But just in an effort to inject a little enthusiasm into the dialogue, I wanted to mention those.
I love it when people try to get positive. Can I get negative again?
Why not?
No. Anybody have anything to add to what Bob just said?
Well, listen, I think, again, it's like you get in these scenarios and people like to talk their book, but I would tell you that many public REIT, if you look at the value vis-a-vis other public securities, are on the value end of the spectrum. Now, we're not sexy.
So what causes that to change, though?
I think it's an appreciation that it is cheap and ultimately new capital has to come into the market, right? We had a lot of Japanese money that came in and that's come out.
Why don't we see more take-private transactions and
well, we've
and
seen
more,
a lot
more
in we've seen a lot in my sector, right? The French are buying the Australians to get London and the U.S. So I'll try to explain that later. Unibail is buying Westfield. We've seen Brookfield buy General Growth. Brookfield bought Rouse. I mean, so there is more and more privatization occurring.
Isn't it interesting that the street's perception of the NAV of General Growth was 29 to 30, and they're paying 23 for it?
Yeah. Well,
what does that say?
It says is that you've got a smart buyer that's taking advantage of the situation, right? I mean,
and there's nobody else
and by the way,
him.
There's nobody. Yeah, the only guy to challenge him is me.
You.
I know, and I just didn't
You've
feel
already
like
been
it.
to that movie.
And I didn't feel like it. So, because then Bloomberg, I see these Bloomberg articles, the retail apocalypse, and this and that, and it makes me see. If you were more positive, I would have cheated and bought General Growth. It's your fault. Oh, sorry. Thank you.
I only want to make one small comment about retail, and I really don't know much about this field, but if I enjoyed the experience of going into a mall, my kids don't even know how to spell mall. They don't go there, they don't use it, they buy it all through the internet. So either it's a generational or habit change which is taking place, but I think it may have to restructure the whole concept of retail and mall experience.
What happens, so e-commerce provides us with a pretty darn good illustration of what happens when real estate meets technological disruption. Mm-hmm. What happens when self-driving cars show up?
How old are you?
How old am I?
Yeah.
How old do you think I am? No, I'm 38.
You're too old to be around for self-driving cars.
You think they're that far away?
Yeah.
What about the rest of you guys?
I disagree. I think it's coming faster because all of the technology that's occurred has moved faster than originally projected, and it's going to have an impact. Let's take parking garages, okay?
Mm-hmm.
Right.
Yeah, that's what I have in mind.
It's been a good business, but I think its future has some doubts because when you have more self-driving cars, you may have a lot less need to park. In fact, as people are developing new projects now, I'm talking about office, and you have to build a certain amount of parking, the developers are designing the buildings so they can get rid of a lot of the space that they're putting in now and convert it to office or other uses for what is now parking.
So and that'd be like a shadow supply.
Yeah.
I would just say, from our standpoint, when we historically had to park 5 to 1, essentially 5 square feet for each square footage, 5 square feet, we'd have to provide 1 parking space. So and again, if you think about the suburban mall, it's usually the best location in the better demographic, not all of them, but by and large. So suddenly we have these parking fields that are way underutilized. And it's almost like for us, if that happens, actually, it makes, the #1 complaint that we have at the mall today, and this is counterintuitive, and this is what actually, think about it. So the #1, we do all this customer research, the #1 complaint, counterintuitive, is parking. Now, since all these malls are vacant and nobody goes, it's hard to understand why that's the #1 complaint. But so suddenly parking becomes less of an issue, right? Because people get dropped off. That may, that's a little more, who knows? But the reality is we're way overparked, and we've got the best real estate location in these cities. And so it gives us, and get to Sam's point, if there's no demand, what do you build? But
No.
Okay, I got it.
My answer is you're creating a lot of new multifamily locations.
You got it.
Locations that previously didn't exist, and they're now going to be very much there because they're going to be very attractive.
Right.
But that's called supply.
I agree. But we have all this land, and it almost goes back to the Sears situation. One of the great opportunities we have is to reclaim, all these Sears stores. Or, we have a simple example in Buckhead, Atlanta, where we have a Saks and a Nordstrom, and we had a Belk department store. Belk, it was a high-end mall, so Belk's kind of a nice department store, but more moderate. We're taking that back and building, again, Sam's going to beat me up for supply, but in Buckhead's a unique piece of real estate. So we're building a Nobu hotel, Nobu restaurant, office, Lifetime Fitness, which is a fantastic company, 100,000 square feet, and their co-working space and their sports space.
Is he allowed to advertise?
And again,
He did. He sort of gave himself an out by saying pretty early on that he was talking his book.
Yeah, I was talking my book, but again.
And
that's what I have to defend myself, right? I mean, it's a tough world.
I wasn't asking you to defend
No.
retail. I was asking you to comment on self-driving cars.
No, I think, I did answer it, but then I went a little bit too far. Okay.
So the other thing about self-driving cars, I think, brings up the question of how relevant or whether central business districts will remain as primary as they are, or whether you can see the development of satellite areas, sort of prime suburban satellite areas where you can replicate the office and residential in the parking.
Because you don't need the transportation arteries.
Because you can be more self-contained. Whether you're in a self-driving car or driving yourself, most people don't want to spend a whole lot of time in vehicles, and so you could well see a bit of a hollowing out of some of the central business districts and the rise of some prime suburban areas as well, because you have more land available to develop the right infrastructure.
I think that's the operative word. More land available. And when more land is available and money is available, guess what happens?
The S word.
You got it.
Eyal.
No. I didn't want to talk too much about self-driving cars because this is the real estate panel.
Oh, no. What happens to real estate with self-driving cars? Neil brought up the point about parking garages, for example. What I'm trying to tease out is this idea that there's technological change and it creates disruption in different industries. We've seen it happen in retail and e-commerce.
The real answer, Neil, is that an app called Parking Hero, which effectively tells somebody who's coming into the city where there's spots available, has dramatically reduced the monthly rental in parking structures. That's a big technological disruption that affects cash flow. I wouldn't worry. I think that I think self-driving industrial vehicles, trucks, is for sure much, much, much closer, and there's much more economic justification for that than the self-driving car. Self-driving car, remember what was it, 3 years ago when everybody was zip-carring everywhere? Funny, it's gotten very quiet. All of a sudden, everybody doesn't want to share a car. There's no economics or driving economics to sharing a car. But if you're a trucking company and you can't find drivers, and you in effect have an interstate that's already in place with which you can build a self-driving structure, that's much more justifiable and much more likely to be a factor going forward than the self-driving car.
I would say that the other impact of, obviously, I believe more in self-driving cars than maybe you do in terms of how fast it happens. We'll see what happens. But the other impact is, I actually think it's the reverse. I think it's going to help downtown areas because it's going to be easier to get to work. All right? If you don't want to take the train, you can get there. You don't have to drive. It'll be easier for people to double up and do everything. So I think it helps downtowns.
So now, what we do in order to accommodate the need for ease of transportation is build cycle rooms and showers for residents of the building, tenants of the building. So the storage room for bicycles in our buildings in Manhattan now are
much bigger.
Huge. We are talking about close to 1,000
How about
bicycles.
storage rooms for packages? That's a huge problem for us. Huge problem.
But on the other hand, the technological advancement is changing the way in which office users are basically utilizing the space. The space per worker has now shrunk from about average of about 200, and in some places down to 100 square foot per employee.
Well, it's a good thing we don't have any more supply coming.
So the thing
The server rooms have disappeared, the package rooms have disappeared, the cable rooms have disappeared. All this technology is really making superior usage of the existing spaces of office buildings.
So if it's not necessarily self-driving cars, Neil, you think it might be, Sam, you disagree. What is the next technological disruption to confront real estate?
I'll give you one thing to think about. Since Uber and Lyft have become so prevalent, the use of public transportation across the country in every single market is down, which is somewhat counterintuitive. But literally, subway usage in New York, subway usage in Chicago, BART in San Francisco, everywhere public transportation is down 5 to 8%. What does that mean? And do we have? What about how many highways we have? And we talk about self-driving cars are going to make public transportation even more obsolete. What's the impact of that going to be? And how is our society going to take on because with reduction in demand on the public supply, public situation, they're not going to build as many subways. Then what do you do?
I think that is an excellent big question with which to leave our audience. As we wrap the Real Estate Outlook panel, please join me in thanking our panelists for their time and contribution.
Thank you.